During the first quarter of 2025, you have seen a gradual deterioration of the economic prospects for the US. Part of it is just bad weather that we had in the US in January and February that has delayed some investments, some activities, some consumption, and will have an impact on GDP forecast. But more importantly, we have seen an increasing impact from the cuts of the Department of Government Efficiency and an increase in regulatory uncertainty, both because of the activities in the new departments and because of all the debates about tariffs. We think that during Q2, we are going to continue to see a gradual deterioration of economic prospects for the US market. To see how much and how fast, to say how much and how fast right now is really difficult because we don't really know many of these policies, so it will be important to be able to react to these different policies and the impacts that they may have. One thing is for sure, if you are cutting some expenses, they are impacting some jobs, they are impacting the economy immediately with a multiplier effect. While if you reduce regulation and you try to attract investments from abroad, those investments will actually manifest themselves only once the regulation, the new regulation, whatever it is clearer. So you're going to have a delayed effect. So my expectation is that we're going to see a continuing slowdown of the economy before we start to see the delayed impact of new investments, probably in 2026. So this is a year in which we need to be careful about cyclical risks. And as I said at the beginning of the year, the way to face a market and an economy like this is to be able to eliminate the biggest risks that today you have in the market. And in my opinion, the biggest risks that you have on the US market right now is an excessive concentration in only a few securities, a valuation risk in certain parts of the markets that are clearly very, very highly valued, and a geographic risk. The US has grown so much that they represent over 70% of global equity. And so most investors, they are invested only in one market, the US, only in certain type of security, growth, and mostly in mega caps. They may have very different funds only to discover that all those funds at the top, they own absolutely the same security. This is very, very risky. And on the other hand, if you diversify these risks with more diversified portfolio that has more of an equally weighted type of approach rather than a market weighted type of approach, if you have discipline on the valuation and you avoid the highly valued part of the market that typically are the more speculative growth components of the market, and you have a more geographically dispersed approach to your investment with also the presence of international investment, you are going to have a much more balanced experience. Also because the valuation, especially outside the US, are so much slower in the US, and we probably, it looks like we are going to have very significant fiscal stimulus, both in terms of infrastructure spending and defense spending in Europe. And also Asia is starting to bottom out and improve, especially China is starting to finally stabilize. So diversification, as I said at the beginning of the year, is the rule of the game this year, and I think it will pay off particularly well this year.